Gold's price experienced a shocking drop last week, yet was able to recover the lost ground in the following days. We tend to maintain our worries for volatility to be maintained in the next week, yet at lower levels given that the gravity and frequency of US financial releases is expected to largely ease with some exceptions. Today we are to discuss the fundamental challenges laid ahead for the precious metal, while we'll be concluding this report with a technical analysis of gold's daily chart. Gold's price experienced a shock last Tuesday as the release of the US CPI rates for January took the markets by surprise. On a year-on-year level, the headline rates slowed down less than expected, while the core rate failed to slow down at all. The releases tend to highlight the persistence of inflationary pressures in the US economy and eased market expectations for the Fed to start cutting rates early and proceed with an extensive easing of its monetary policy. Market-wise, the release of January's US CPI rates provided extended substantial support for the dollar, while the strengthening of the dollar tended to weigh on gold's price given the negative correlation of the two trading instruments. Overall, we expect the market's expectations for the Fed's monetary policy path to be influenced substantially from any statements that are able to be made from Fed policymakers in the following days. Should Fed policymakers highlight a possible faster slowdown of inflationary pressures in the US economy, we may see it supporting gold price, while on the flip side, should Fed policymakers highlight a scenario that rates remain higher for longer, we may see them weighing on gold's price. Please note that San Francisco Fed President Daly highlighted a scenario where the bank will proceed with 3 possible rate cuts this year, a scenario that was also supported by Atlanta Fed President Bostic and contradicts market expectations mentioned earlier. We highlight the release of the Fed's January meeting minutes tomorrow as the next big test for gold's price, given also the importance the Fed's stance has for gold market participants. In line with the analysis before, we expect that should the Fed's meeting minutes show a decisiveness to maintain a tight monetary policy for a longer period, we may see the release weighing on gold's price and vice versa. Also, we note the release of the preliminary S&P PMI figures for February, as well as the weekly initial jobless claims figure, both due out on Thursday. Any release that may provide some support for the dollar may at the same time weigh on gold's price. On a technical level, we note that gold's price was able to reverse the wide losses on the day of our prior report and break the 2020 resistance line, now turned to support. As the downward movement seems to have been interrupted and the price action of gold has broken above the reading of 2020, we switch our bearish outlook in favor of a bullish one. The consecutive upward movement of the past 5 days seems to have started to form an upwards trend line showing the limitations of the upwards movement. At the same time, we note that the RSI indicator is recovering and has reached the reading of 50, implying that the bearish sentiment of the market for gold's price has faded away. We tend to maintain our bullish outlook as long as the price action remains above the upwards trend line noted before. Should the bulls actually maintain control over gold's direction, we set the next target for buyers of gold at the 2055 resistance line, while even higher we note the 2090 resistance hurdle. For a bearish outlook, we would require gold's price initially to break the pre-mentioned upward trend line, clearly signaling the end of the upwards movement, to continue to break the 2020 support line and take aim of the 1972 support base.